In our view, AI is following the historical pattern of major technological transitions, in which investment and capital formation lead economic change. We believe this dynamic is now clearly visible in the data. Last year, real business investment grew nearly twice as fast as overall GDP, while technology-related business spending grew roughly 10 times faster, reinforcing the investment-led nature of the current cycle. And we expect this trend to continue as AI disrupts certain industries, with some segments of the economy becoming materially diminished, creating real economic pain for those affected. This dynamic will drive more value accrual to capital than to labor in the short to medium term, in our view. As a result, we believe portfolios should be positioned to capture business investment broadly and AI infrastructure in particular as the core enabler of this transition. Over the long term, however, we believe the U.S. economy will once again demonstrate its dynamism, reabsorbing labor, sustaining income growth, and ultimately supporting continued expansion in consumption and overall economic prosperity. Renowned economist Joseph Schumpeter described capitalism as a process of creative destruction, the continual dismantling of old economic structures and their replacement with new ones. Major innovation in this framework isn't additive at the margin, but disruptive by design. It destroys specific firms, industries, and professions, even as it expands total productive capacity and long-term wealth. At the turn of the 20th century, roughly 40% of the American workforce was employed in agriculture. However, the advent of mechanization, such as tractors and combines, allowed a small fraction of that labor force to produce far more than the entire sector had previously. Now, if one had projected forward from that moment, the fear of mass, permanent unemployment would have seemed entirely rational. Where would tens of millions of displaced workers go? The flaw in that question is that it assumes the future labor market must be visible from the present. It wasn't. Displaced agricultural workers didn't move into roles that already existed. They became factory workers, railroad laborers, miners, and machinists, and ultimately moved to new industries such as logistics, aviation, computing, and software. We believe this is the core insight of creative destruction. Value and labor don't vanish when productivity rises, rather they're reallocated. In our view, an overly bearish stance on the economy and equity markets risks underappreciating the gains that have historically accompanied periods of rapid technological change. For more than 6 decades, Algiers used deep, fundamental research to identify the innovators reshaping industries, from the PC to the internet to smartphones, and own them through periods of transformative change. As AI redraws the competitive landscape, we believe that disciplined, research-driven selection will be more important than ever.